This video is going to cover the first part of stock valuation. Before we talk about different methods of stock valuation, there are different definitions for the company's value. So there is book value, there is market value, and there is also liquidation value. So we talked about the book value and the market value before. The book value, which is the net worth of the firm according to the balance sheet. The market value is the value decided by the market. You can find the stock price per share on the exchange. Say the price is $10 per share or $20 per share, and you can find the numbers of outstanding shares using the price per share multiplied by the outstanding shares, the number of outstanding shares. You can get the market capitalization of this company, and that's the market value of the company. Today, I'm also introduce the liquidation value, which is the net proceeds that could be realized by selling the firm's assets and then paying off its creditors. So, for example, a company may have different types of assets. They have marketable securities, they have cash, they have account receivables. Those things are close to cash. They can easily be transacted to cash. Or there is other assets. For example, a company may have some real estates, or it may have a factory. Those things are less liquid. If you want to sell them in a very short time, it's likely to lose its value. So say if you have a factory that's worth of $1 million on the book value, the market value might be estimated to be $1.2 million because the land is appreciation in values. However, if you want to sell it in 2 days, you need to cut your price to find a buyer. That means the liquidation value of this real estate of this factory can be much lower than its book value and market value. Similarly, there are other intangible assets that the company may have. For example, the company may have some intellectual assets like a patent, and those things they can have a very high market value when the company is doing well. It may have very good potential to generate future revenues. However, if you need to liquidate its patent, you want to sell it to another buyer, you may lose its value significantly. So in other words, there are different definitions for the company's value. There is book value, market value, liquidation value, and you need to apply different definitions or find the one you are caring for when you ask the right question. So for example, if you want to say, should I buy this stock for this company? You are looking into the market value. You think by different evaluation methods, you think the company is worth $10 per share. However, the market price is $12 per share. Then it means it's not worth buying, not worth purchasing. However, it may be an opportunity for you to short this company. Okay. In another example, if the market value of the market price of this company is only $5 per share, however, you think this company is worth of $6 per share, then maybe you should purchase the share and wait the price to go up in the future. However, if you have to ask a different question, say, if I'm already a shareholder of this company, but I'm a little bit concerned that the company will be in some kind of financial distress in the future, then you should keep a close eye on the liquidation value of this company. What if the company is going to be in financial distress and go bankruptcy? You want to know how much money you can get back after the company sell out all its assets and pay off the creditors, what's left for you as a shareholder. So you ask different questions and you need to find the correct or the corresponding value that answers your question. Okay. Next, we are going to talk about different methods of stock valuation. So the first method is the valuation by comparables. Say if there are two companies that they can resemble one another, they are in the same industry, they have similar business model, and maybe they have similar capital structure. So you will expect them to have similar behavior patterns, and they will have comparable share price. So depending on their ratios, you do some adjustment. So the ratios here can be the price to earning ratio. The ratios can be its efficiency in using its asset. So when you're doing adjustment based on those ratios, you can estimate the stock price of one company from another. Say, for example, the Walgreens and the CVS, they are both pharmacies, and they are in the same industry. Although they may have different market shares, but you can estimate the stock price from one to the other. If you know the stock behavior pattern of Walgreens, you would estimate or expect a similar pattern for the CVS. So that's valuation by comparables. Another valuation method is the intrinsic value. That's the present value of future cash flow payoffs from a stock or other securities. Okay, we will talk more about this today. And the third method is called the dividend discount model. And we'll talk about this model in next video. Okay, let's get started with the intrinsic value. So we call the intrinsic value V0 here in this formula. You can understand it, you can take it as the present value of this stock, the value today. And we have expectation of this stock. We expect it's going to pay a dividend in the end of year. So we call this dividend 1, DIV1 here. We also predict the stock price to be P1 in the end of year 1. Okay, and the discount rate for this stock is R. So we know the future price in year 1, the future cash flow we are going to receive, which is the dividend in year 1 plus the stock price. And to be a fair value for the stock, we'll expect the future value in year 1 discounted back to today will be equal to the price today. So DIV1 plus P1, the cash flow we receive in the end of year 1 divided by 1 plus R discounted back to today shall be today's price V0. So this is what this formula says. Let's look into a numeric example. So what's the intrinsic value of a share of stock if the expected dividends are $3 per share and expected price in year 1 is $81 per share, and assume the discount rate is 12%. So in year 1, if we are holding this stock, we will have a dividend of $3, and then we can sell the stock for $81. So in the end of year 1, the total cash flow we get is 3 plus 81 equals $84. And the interest rate is 12%. So discounted back to today, the $84 divided 1 plus the 12% gives us today's present value or the intrinsic value of $75. Okay, that says it's the fair price here for the stock today is 75 if we expect the dividends payment to be $3 and the stock price to be $81 in the end of year 1. Okay, so these things are all based on the expectation price and expected the expected dividends. Can our prediction be wrong? Of course. Well, no one can really predict what the stock price will be. However, we are making decisions based on our prediction. Okay. So based on this prediction, what's the rate of return are we going to get? So the next example, we are going to introduce a concept called expected return, which is the percentage yield that an investor forecasts from a specific investment over a set period of time. And sometimes we also call it the holding period return, or we short it for HPR. Okay, so the expected return is the amount of money, the cash flow you receive in year 1 minus the price you pay to purchase the bond divided by the purchasing price. So the expected return will be dividend plus price in the end of year minus the starting price divided by the price you make the purchase. Okay, so that's the formula. And using the previous example, we can calculate the expected return as in the end of year one, we are going to receive $3 plus 81, and we pay for today. We purchased the stock today for $75, so minus 75 divided by the purchasing price divided by 75, that gives 0.12, which means the expected return of purchasing this stock and holding it for 1 year will give you an expected return of 12%. Okay. And we can further break this formula into two parts. Okay, so there's dividend yield, which is the return comes from the dividend, and also there's capital appreciation, which is the return comes from by the raising price of the stock. Okay, so in the formula, we can also break it into two parts. So we have dividend 1 divided by P0 plus the price change P1 minus P0 divided by 2P0. So the first part is dividend yield, the return you get from the dividend. The second part is the capital appreciation, the return you get from the raising price of the stock. Okay, so again, go to the numeric example using the previous example. The dividend is $3. So $3 divided by the purchasing price, $75, gives you a 4% of dividend yield, which means the dividend yield for this stock is 4%. And the capital gain is 81 minus 75. You sell it for $81 and you purchase it for $75. So the capital gain is $6, and the return for the capital gain is 6 divided by 75 is 8%. So in other words, the 12% expected return can be decomposed into two parts. The first is dividend yield, which is 4%. Second is the capital gain, which is 8%. So why do we care? There are two different parts because they will be taxed differently. Okay, so you pay different tax, and there are different tax rules for the revenue comes from dividend yield and the money you make from the capital gain. Okay. So the story here is, as I said earlier, in the intrinsic value, we are predicting the future return or the future price of this stock. The prediction can be wrong, of course, and it's very hard to get it right. So we are always predicting things and we're always forecasting things. And based on those assumptions we make, we can get a price, a predicted price, and we can get a predicted return that's for holding this stock. Okay, so this is just one model for evaluate the stocks. Because it's so hard to predict the price of the stock, sometimes it's easier to predict the dividends. So in the next class, I'm going to introduce the dividend discount model. Okay, so in that model, we are making assumptions saying we are holding the stock forever, so we don't need to predict the future price. We only need to predict the future dividends, and all the income we get shall be coming from this dividend. Okay, and by discounting this dividend, we can calculate the price of the stock today. Okay, so that's going to be for the next video.